The net profit margin is the ultimate analysis for a bookkeeper. Using this ratio, a business owner can see what their profit really is once they factor in all of their expenses and operating costs. Because the net profit margin shows the overall success of a company, a business owner can use this information to make sure that they are pricing correctly. And in general, just make sure that their business can actually be profitable in the long term. You know why they call it the bottom line? It's not a trick question. It's because your net profit is literally the last line on the income statement. Did I just blow your mind? Anyway, let's take a look at class income statement to see how to figure out the net profit margin. It's pretty easy. You just take the net profit and divide it by the sales revenue. This will show you what the actual percentage of every dollar is being kept once every expense and cost is factored in. Let's see it in action. Okay, based on this ratio, it looks like Claire has a 29% profit margin. In general, this is an excellent profit margin for any business. However, remember, this can vary by industry, so it's important to make sure you do your research. Before we wrap up, let's hear from our expert.
So the net profit margin is after we have calculated our gross profit margin. Sales minus cost of goods sold is our gross profit margin. Then we have our expenses. That gets us to our operating profit margin. Then the question is, well, what's after that? Is the net profit margin. Typically, the net profit margin happens after taxes. Now, for most small businesses, and I mean the vast majority of them, they don't have taxes. Because of the type of entity structure they are, they themselves don't incur taxes. The owners do. A lot of our clients are going to be LLCs or they're going to be S corporations. So those taxes are not reflected on the business's financial statement. So the operating profit margin and the net profit margin are likely going to be the same. If your client is a C corporation and itself incurs taxes, so the business itself has its own tax return and its own tax that it incurs, that it needs to pay to the federal or state government, then they would have that tax recorded as an expense after the operating profit margin. And so then they would calculate net profit margin after that. But again, the majority of the time, it's the profit margin, and we kind of call it that instead of operating or net profit margin because there are no taxes. Now, sometimes there are people that will put income earned or miscellaneous random expenses after the operating profit, but technically from a real bookkeeping accounting perspective, it's typically after taxes. So again, net profit margin, you're going to take the operating profit margin less taxes, you get net profit margin. And again, there should be a ratio or a target that the client is looking for. And we would just help them to understand that, explain that to them, kind of put an idea together on a budget of where they should be heading to and help them to understand they've got to have the cash flow and the things that they need to be able to take care of that. And that net profit margin is ultimately what they're taking home.